We are extremely excited to have Club Capital's own Louisa Else with us here today, along with their CEO, uh, Micah Cannon is here. Uh, we know that tax season can be really stressful. I know that I personally don't like doing taxes myself. So we're really glad to have Club Capital here. They are the premier accounting and tax advisory firm for insurance agents. They're currently serving over 1,000 agencies nationwide. It's co-founded by top agent David Munson, and their advisory service helps agents drive growth into top line revenue and enhance bottom line profits. They want to enable you to take control of your business and not let it control you. So introducing Louisa Else. Louisa is the Vice President of Tax for Club Capital. She joined the firm in January 2023. She oversees all aspects of the organization, working closely with the tax, accounting, and advisory teams. Louisa has been a CPA since 2014 and has worked in the tax and accounting teams of all sizes. So we really can't wait to hear all of her valuable knowledge. Whenever you're ready, Louisa or Micah, I'll hand it over to you.
I appreciate it, Gina.
Great.
Just a couple of things. We'll get started here and not delay it all. But thank you guys for having us on. Appreciate it. I know we've been on on the Quote Wizard webinar series a couple times in the past as well. So good to be back, and good to be chatting with everybody here today as well. It is tax season, right? So it is on the mind of everybody right now. For those that are trying to press forward and do this ASAP and get things in by April 15th, as well as just those that, even if you are kind of typically do extensions, which we see, a lot as well. There's a lot to understand and get ahead of for tax season right now. It's not just about filing taxes, but it's about making sure that we plan ahead, even in current years, and understanding what are some changes, not just looking at 2024 taxes and what do you maybe need to know, but looking ahead, right? Taxes and tax law can change year to year too. So one of the things we're going to do today is I think just talk, generally about some tax minimization techniques, which is great for everybody to understand. And obviously some top hitters that everyone wants to walk away from. There's also some things that employees will cover that are on the, some things to maybe look out for. Some things that are coming down the pike, or some things that are maybe unsure of, right? So what things are changing in 2025 and what things might change. There's a new administration in or back in office. So, what things are changing? What do you need to look out for? What do you need to look out for in terms of headlines in the news? That could definitely impact the business. So, I will primarily be quiet today. This is Louisa is definitely the resident expert, with Club Capital. So I'll let her give an intro and get started, and I might just help with any color commentary or questions from here. But Louisa, go ahead and kick it off.
Awesome. Thanks, Micah. I will go ahead and start sharing my screen here. So holler if it doesn't show up. Super excited to be meeting with you guys. I was just talking with Gina and Kelsey earlier that, we did this a couple of years ago. So excited to bring this back to this audience. As Micah mentioned, it's 2024 tax season right now. I'll be honest, I'm not going to tell you a bunch of stuff today that affects your 2024 taxes. What I'm going to talk about is 2025. And what you want to do even right now to start thinking about your taxes for 2025. I always tell people, if you are a client of ours and you've talked to me, you've probably already heard me say this. If you come to me right now for 2024 taxes and say, hey, Louisa, how can I save on last year's taxes? I'm basically going to say, hey, I can give you a couple of things, and it's contribute to this retirement account, contribute to this retirement account, maybe an HSA. Our hands don't have a lot of options. Our hands are a little bit tied once we get post December 31st. Prior to December 31st, though, there are just tons of opportunities, strategic ways to think about your business to really help you look forward. So while yes, right now, all of our brains are thinking about 2024, I'm going to flip the script a little bit, and we're going to focus just in general on tax planning items, most of which are going to be things that you can implement for 2025. And then as Micah shared a little bit, I'm also going to flip a little bit to things that are on the horizon for 2025 and going forward, because we do have a year of some uncertainty because of the new administration and some of the expiring tax provisions that are going on. So I will flip to that kind of in the second half of the presentation. So this is me. I'm our Vice President of Tax here at Club Capital. I just celebrated my 2-year anniversary with Club Capital, which is super exciting. I started as our General Manager back in 2023. I am now currently our Vice President of Tax, really taking everything from the past couple of years and focusing it on our tax team and our tax practice. All of my background is in accounting and tax. I've done it in about 4 or 5 different places and ways, working with different types of clients. So really have a broad background of different things and different strategies, and then taking those and really focusing in on what is most applicable to insurance agents and what very similar situations sometimes you guys might find yourself in that everybody can learn from and maybe take advantage of. Micah talked about this a little bit, so I won't spend too much on this slide, but we are Club Capital. We work exclusively in a couple of niches, the main one being insurance agencies. We are able to provide a lot of agency-focused metrics, forecasting services, strategy, along with just doing your books every month. That really helps you as a business owner take control of your business and really understand where the numbers are at. So when we talk about minimizing our taxes, there's really 2 things to think about. The first one is reduce the profit you're taxed on. Maximize your business expenses. Think about tax deductions, opt into those. Really just, okay, what is my bottom line? Let's make my bottom line less. The second is thinking more about sheltering taxable income. And I can tell you that I didn't write this slide because I hate the word shelter. Tax shelter has a bad connotation, right? But there's really good ways to do it. Taking taxable income that you would have and moving it into different places, deferring tax down the line. The biggest example of this is retirement funds. Hey, I earned $90,000 last year, but I maxed out my 401k contribution. So I put 22,000 of that into my 401k. And so I'm only paying taxes on 68,000. Can I do math? Usually. So there are a lot of different tax minimization strategies. I'm going to go over all of these. There are a couple of these that I have more detailed slides on, just to kind of look through it. The first one is thinking about meals and entertainment. There are different tax rules for those 2 categories, as opposed to most expenses. Most expenses are just a tax deduction. It reduces your income, dollar for dollar, great, you can deduct it. Meals and entertainment have different rules. They've had slightly different rules over the past couple of years with some of the COVID relief that came through. Now we're kind of back to the status quo from the 2018 tax reform. Before 2018, it was just 50% deductible for pretty much everything. And so business meals, travel meals, entertainment, all of that was 50% deductible. The idea behind that is you can't deduct your own meals, you'd eat anyway, but you can deduct the 50% that you're spending with other people. Since 2018, entertainment, so taking clients out, anything like that, doing the concert tickets or maybe a sports game, any of that, 0%. Golf. The biggest example of this is golf. Golfing is considered entertainment, so that's 0% deductible. Meals are now back to 50%. But there are ways to plan things out, so maybe you can have a little bit more there. For example, a meal with your team member is 50% deductible. But if your whole team is there, then it can be an event. And so then that would be 100% deductible. Same thing for entertainment. When you're out with clients, no, that's not deductible. But if you are doing like a team building event, something like that, then that still counts as a deduction. So just kind of being aware of where you're spending that, and knowing, if you're choosing to make the expense in other ways, that entertainment or some of those meals, you will be limited in your tax deductions. Adding your spouse and kids to payroll, this is a great opportunity that small business owners don't have, that I don't have as a W-2 employee. And so that's a great way to help your kids as well as helping your bottom line. I'm going to go into that a little bit more on the next slide, because it really becomes super helpful when you're doing it in combination with the next point, which is the levering company benefits. I'm going to do a second slide on the pass-through tax too, so I'm going to skip that for the moment. Section 179, vehicle depreciation. This is probably the hottest button that I hear people talk about all the time. You want to write off your new car. You certainly can. There's some accelerated depreciation you could take on that. The most important piece is that if you are incorporated, you make sure you buy that vehicle in your agency's name, not in your personal name. That allows you to take the biggest chunk of benefits to write off additional amounts of depreciation on that vehicle in the first year you buy it. The last thing I'll hit on this slide is the Augusta rule. This is a tax strategy that is available to incorporated agents. It's not really recommended if you are a sole prop, but if you have a separate legal entity for your business, this is a great opportunity. The name of it comes from Augusta, Georgia, where the masters are hosted. And what the rule essentially says is you can rent out your own home for up to 14 days without having any taxable income result from it. Anybody can do that as long as they own their own home. You can't do it if you're a renter. I can do it, Micah can do it, but where it becomes a really great business strategy is if you rent out your home to your business. That's a separate legal entity. What I always tell agents is you've got to make it real. Please don't at the end of the year go, oh, I can do this for up to 14 days. I'm going to write myself out a check. You need to document it. You need to have a business use for it. And then you can pay your business can write out a check to you for the fair market value of your home for up to 14 days. Great examples I see of this are holiday parties, maybe a summer barbecue, leadership meetings or management meetings, maybe where you'd hop out to a coffee shop and instead come do it in your living room, maybe bring some of like a monthly strategy meeting. Those are some of the things I've seen. Certainly there are other opportunities there. Again, the biggest thing is just to make sure that there is a valid business reason associated with it, and you're using a reasonable amount for your fair market value. That varies greatly depending on the size of your house, the location you live in. Somebody in downtown Chicago, they can write themselves out a much bigger check than somebody like me up in small town Wisconsin. The rental value is very different. I'm going to take a breath if anyone has questions, otherwise I'll skip to the next slide here.
Louisa, I'll just jump in, just clarifying the meals expense. So a question around meals. Taking employees or clients out for lunch, confirming that is 50% deductible, just not the 100% deductible.
Yep.
Yep.
It was 100% deductible for about 2 or 3 years around COVID because they were really trying to encourage us all to keep restaurants in business. That ended as of 2022, or as of 2023. So 24 is back to the 50%.
Yep. And then some clarifying things around Augusta rule. So the 14 days does not need to be consecutive, right?
Sorry, yes, correct. Like I said earlier, when I'm doing tax planning calls with individual agents, my 2 cents is, hey, if you do a holiday party, you do a summer barbecue, and then you do like a monthly strategy meeting, that's your 14 days. It also doesn't have to be exactly 14 days. If you've only got 2 things that make sense business-wise for you to add in for your business, that's fine. Those 2 days, say, the fair market value of that is $500. Those 2 days create $1,000 tax write-off for you. More is great, but you don't have to hit that 14 days in order to take advantage of it. It's anything up to 14. Don't go to 15 because then all 15 days become taxable, not just that then 1 day over. So if you go to 15, you lose all the tax benefits.
Right, gotcha. And then around the Augusta rule, LLC is included for incorporated business.
Yeah.
Correct.
Yep. Separate legal entity. Yeah.
Yep. It's a legal entity that's not a sole proprietor. So LLC works there. And then is this, the question was, is this per business, right? So if we have 2 businesses, can we do the 14 days per business?
It is not. So the 14-day rule applies to individuals, not necessarily to the businesses themselves. So you as an individual can rent out your home for up to 14 days without having taxable impact. That can be to 14 different people or entities, or it can be to 1. So if you've got 2 businesses, that's 2 opportunities to get to the 14 days, but it's not per business. It's 14 days total for you personally. If you hit day 15, then it has to go on your personal tax return.
Right. And so to other people kind of asking questions around here, remember this is in essence a 1040 strategy, right? So this is how to reduce taxable income on your individual return. So it's not necessarily something that is taken on like sometimes on the business side, it's like how it's taxed internally or individually. And so it would be, kind of the same thing applicable on like a joint return. So the question was like, what about per spouse, right? So it would be only 14 days on like a joint return, correct?
Correct. Yeah. So the weird caveat to that is the write-off itself is at the business level. Now, most of you, I think, are not C corporations, so the income of your business flows through to your personal return. So the write-off is from the business. However, the tax strategy, the help, the really big kicker is that 14 days, and that is personal. So essentially what happens is your business is writing out a check to you personally, and you personally have income from that rent. And so the way to take advantage of this is to make sure you don't have personal income, you and your spouse combined, of rental income for more than 14 days. Because from days 1 to 14, you as an individual don't have to put it on your tax return. Even though you got, let's say, $1,000 a day, even if you got $14,000, you don't put that on your tax return anywhere. It's beautiful. But your business still has $14,000 less of taxable income because they got to take that write-off. What happens if you go to day 15 is, yes, your business gets to write off, in this case, $15,000, but then you have to turn around and put $15,000 of income on your personal tax return, and essentially it nets out to zero. So once you hit day 15, it's fine, but essentially you're not saving yourself any taxes. You're just moving taxable income one place to another. As long as you stay 14 days or less, what you get to do is take the deduction, but you don't have to go put that income anywhere else.
Correct. Yep. And so, obviously the spirit here is of the law is not to just simply use this as a strategy, but the idea behind it, to some of the questions that were posed here, is that yes, it's a business related event for your business, right? So retreats, it doesn't need to be, you're not necessarily taking your entire team on a 14-day vacation, right? But you're using your home, your property, for 14 days out of the year for, whether it's retreats, business meetings, things of that nature.
Exactly. And this can apply to a second home as well, with the caveat that you're not doing it other places. So most of the time I see folks, if they have a lake home, something like that, they're like, hey, I have an Airbnb. As soon as you tell me Airbnb, I say, nope, this strategy doesn't apply. Because yes, you can have your business rent your lake home, but you're over the 14 days. Awesome. I'm going to go ahead and move forward here. And there are a couple that I've just got some illustrating slides for, so I wanted to have a little bit separate here. The first one is that piece of leveraging company-sponsored health and retirement benefits. This really works well when you couple it with hiring either your spouse or your children. The great thing about hiring your children is that if you pay them under whatever that year's standard deduction is, roughly about $13,000, they'll be below the standard deduction, and so they won't have any taxes due themselves, any income taxes, but it's still, again, a write-off for your business. Where it becomes really beneficial is when you couple it up. And so for children, there's different strategies for your kids versus your spouse. But for your children, the way you do it is you set up a Roth IRA for them. And if possible, if you're offering this benefit to the rest of your company, set up a Roth 401k instead of an IRA. Roth accounts, by definition, they are not taxed when you pull them out. So you use taxable income that you're paying tax on right now, you put it into a Roth retirement account, and then in 20, 30, however many years, when you draw those funds out when you're at retirement age, you aren't taxed again because you already paid the tax when you contributed to it. That's a great benefit. And most people, myself included, use Roth and traditional IRAs kind of in a combination to strategize and kind of think what's best for you long term. When it comes to your children, though, when you're paying them that salary that's right around the standard deduction, what you can do is then that's technically when they're paying taxes on it. But since they're below the standard deduction, there's no taxes due. So you can go ahead and move $7,000 of that, let's say $15,000 you paid your child, into a Roth IRA account. What you've just done is you've put $7,000 away that will never have taxes paid on it because your child was below the standard deduction this year, and it's a Roth, so when they pull it out in 40, 50 years, it won't be taxed. So you're actually creating a retirement fund for your kids that they'll never be taxed. If you have a Roth 401k instead of an IRA that they can enroll in, then you can just max that out because you can then put their entire salary into that Roth 401k since it has higher contribution limits. Great strategy as a parent to be able to do that. I will give the same relative caveat that I gave with the Augusta rule, which is you can't get something for nothing. They actually have to do the work. That can be all sorts of different things. And I am not here to judge what work you give your kids or not. Just know that the IRS rule says reasonable. They're intentionally vague. So, whether, depending on the age of your kid, whether that's office work, coming in and helping out. I know a lot of agents use their kids for social media and for marketing. So they pay their kids like a per post fee. That's fair if they were to pay somebody else to come do it. So there are definitely strategies to utilize. Documentation is key. You don't have to submit that with your tax return, but you want to make sure you have it available. So that's a really great way for your kids to not only get you a current benefit this year, but to set your kids up really well for the future. When it comes to spouses, you take the opposite approach. If you have your spouse work for you and say your spouse pay your spouse for part-time work for whatever the max 401k contribution is that year. This year for 2025, it is $23,500. What you can go ahead and do then is you can have them defer their entire salary into a traditional 401k, which means they're not paying taxes on it this year. So you can write off $23,000 from your business and then go ahead and defer that down the line. And so your wife gets that salary, or husband, either one. I do not discriminate. Either one, you can go ahead and defer that, and then you can see some tax savings. So you can kind of see down on the side, I've kind of illustrated it out. The spouse is subject to payroll taxes, so you're paying into FICA and FUTA for that, both as the spouse and the employer. But what you would see is from an income tax perspective, if we use just a rough 20% tax rate, if you don't hire your spouse, you would pay $20,000 in taxes, 20% of that $100,000 business income. But with your spouse and then deferring that income, it actually drops down to about $15,000. So on income taxes, you're saving $5,000. When you add back in an estimated 7.5% for the payroll taxes, you do come in at about a $1,500 tax savings. But some of that is, paying into Social Security, which some people prefer to do, some people prefer to avoid, but you are seeing that benefit on that side too. Some things to keep in mind there for both of these is a safe harbor plan. So you may have some match requirements. If you set up a 401k plan because you want to contribute to your spouse, you're probably going to create a situation where you also have to contribute for your other employees. So if you have more employees than just your child and your spouse, make sure that you know what your obligations are going to be for the rest of your team. It's a great recruiting strategy to have that 401k. It's great to have that benefit for all employees, so that's not usually a problem. But we don't want anybody setting it up saying, I'm going to save $5,000 on my income taxes, and then coming back and say, hey, wait, I had to spend $10,000 for my employees. Remember that employer match for any other employees is a tax deduction as well on your business. And then the second piece is plan-specific age requirements, especially if you're looking at the Roth 401k for your kids. Some plans do require you to be 18 or older. Some do not. So when you're setting up the plan, if you have any plans to use this now or in the future, and you're working with your investment advisor, please just make sure you talk to them and say, hey, can we make sure that people under 18 can opt in and be a participant in this 401k plan?
Yeah, so Louisa, you addressed, I think, a number of the questions that had come in, some around age. I think one of the ones to clarify too, so yes, it can be children under the age of 18. In this case, grandchildren as well, right? I think it's one of the questions.
Absolutely, yeah.
Grandchildren as well.
Yep.
So are they subject to payroll taxes? A lot of this, like some of the strategy comes in around like income levels for the children, right? So one of the benefits here is under a certain level of income, you don't have to pay payroll taxes, right? So, or I think it's not taxes, the income taxes, sorry.
It's the income tax, yeah.
Yeah, so it's specifically around the income taxes, apologies. But yeah, they'd still be subject to some of the payroll taxes, I think was one of the questions there.
And that depends on how you're structured. So if you're a sole prop, they are exempt from the payroll taxes until they're 18. But if you're an S Corp, if you're an LLC, if you're a corporation, then they're not exempt from those payroll taxes. So you actually see a little bit bigger benefit here as a sole prop. But if you're an S Corp, certainly it doesn't negate the benefit that there is. So as a sole prop, those payroll taxes are excluded.
Right.
The other thing I'll mention with that, because it's a common misconception, is your children are not exempt from federal income tax withholding. So a lot of times I see even CPAs recommend, hey, when you set them up in payroll, just mark them as exempt. That's technically not correct. The IRS does not say they're exempt from the payroll tax withholding. What that means is when you put them in your payroll system, it's going to keep out a little bit of their paycheck every month for that federal income tax withholding. And when they get their W-2, it's going to show that a portion was sent over to the IRS. That does not mean that's what they're taxed on. It means that's what's been kind of prepaid to the IRS on their behalf. As long as you've paid them underneath that standard deduction, at the end of the day, their tax is going to be zero. What it does mean is if they want that money back, they have to file a tax return. My 2 cents here is always when I got a job when I was 14, my mom told me if I wanted my refund, I had to go do my own taxes. And look where I am now. So maybe if you want your kids to do taxes and become a CPA down the line, you tell them if they want their, $25 back that they go do their own tax return, whatever that is. But that is a common misconception. The IRS does specifically say they are not exempt from the withholding, even though ultimately at the end of the year, they're not going to owe that tax and they're going to get it refunded to them.
Yep. I think that's good. We can move on to some of these. There are some other kind of nuanced questions. I'll just kind of remind everybody. There's going to be a lot of very specific questions that are very specific, possibly to you and your specific situation as well. So we're going to do our best to try and answer as much as we can. But then feel free to set up a meeting, directly with us. I see a number of current clients here, as well. So, make sure to meet with us, meet with your tax accountant and be able to get some detailed answers here, or set up a meeting with our team, and or your own tax accountant, right? And bring up some of these very specific items to them. We'll share this and make sure this entire thing is shared and sent out. And feel free to bring this to your tax accountant as well, ask questions. And then if any additional or follow-up questions, feel free to reach out to us too.
Yeah, absolutely. So I hit the next star already here. But the last very specific tax strategy I want to talk about before I kind of look towards the future some more is something called the state pass-through entity tax. You'll also see it shortened to PTE, pass-through entity tax. This is relatively new in the last few years. Prior to the 2018 tax reform, the Tax Cuts and Jobs Act, I think there was only a small handful of states that had this election. Mine was actually one of them, Wisconsin. So I knew of it beforehand, but it was very much less common. And what it does is it basically allows us, we just talked about earlier that if you're an S Corp, if you're an LLC, your business itself does not pay income taxes. You file a separate tax return, but it flows through to your personal return and you're taxed on that along with everything else going on for you personally. And what that means is paying taxes is not a business expense. There are different places to deduct state taxes specifically on your itemized deductions, but tax itself is not a business expense because it's not actually your business paying the taxes, it's you personally. So that is kind of how the status quo was, and that is how the status quo is now, unless you consider this pass-through entity tax election. And the reason this really has gained popularity is because part of the Tax Cuts and Jobs Act back in 2018 created a cap on how much you can deduct for itemized deductions on your state and local tax. That's what SALT stands for, state and local. And it said you can only deduct up to $10,000. That includes income taxes, that includes property taxes, real estate taxes, any local taxes as well. And this hit a specific group of taxpayers really hard. High income tax earners, taxpayers, and taxpayers in specific states that have high taxes. New York and California are the top two examples of that. People who consistently were paying between real estate taxes and state taxes, sometimes $15,000 to $20,000, they're now losing out on the benefit of anything over $10,000. That was a huge hit to specific states and higher income earners. And so what the states did, They said, well, we can't help everybody. I can't help somebody who's got a W-2 for $200,000. But what we can do is help business owners. And so what they did is they said, we will create an election specific to state taxes. We can't do anything about what the IRS is doing, but specific to state taxes, where you can make an election and you can say, normally I would pay you tax on the $100,000 of my business income on my personal tax return, just like normal. Instead, you can say, hey, I want to pay you taxes for my business from my business. I want you to tax my business for that income, not tax me. And so either place, either way, you're paying taxes. But what happens is if you make that election, it becomes a business expense, and then it reduces your federal taxable income. And so what that really means is that, say you have $15,000 of tax expense, of SALT taxes. Let's say it's $10,000 of real estate taxes, another $5,000 of state taxes. Without making that election, you lose out on a $5,000 deduction because you're capped at that $10,000. But if you make that election and make it a business write-off instead of an itemized deduction, you can deduct both pieces, and you actually end up being able to write off in a different place on your tax return that same $15,000 that you would be allowed to do without the SALT cap. So I kind of do have an illustration over here using a flat 5% rate. Obviously, state you're in will matter depending what that is. But that same $100,000 example, if you do not make the pass-through entity tax election, your taxable income comes in at about $50,000. Your federal tax is about $6,300, $2,500. And so you pay about $8,800 in taxes. If instead you make that election and you pay $5,000 from your business, what happens is you pay $5,000 at your business, you pay about $1,000 less for your federal than you would before, and you essentially have that same refund. So what happens is, in this case, you had $5,000 plus a refund over here from the business, so you net out to just about the same, $50 more to the state compared to no election, but $900 less. Wow. Yeah, I can do my math. So essentially what it comes out to is you save about $900 in taxes overall. Couple important things to note here. One is, I'm going to get to this later, but this may become less of an issue going forward. There's my spoiler alert. The second is that how you do this depends on your states. Most states are relatively simple in that you can elect it on a timely filed tax return. So you can really sit down and evaluate if it was good for you, if it's going to be good for you or not. So you can say, hey, this year it's beneficial. Hey, next year it's not because I didn't have as much business income. There are states, though, that have a little bit stricter requirements. New York is the worst. New York requires you to elect for the current year by March 15th. So say you wanted to do this pass-through entity election and you live in the state of New York, you've got about a month and a half to make that decision. So you don't get to wait to see how the year goes. You kind of got to project it out. California, I believe, and New Jersey both have slightly different rules too, requirements that you have to get in. California, you have to make an estimated payment. So check on your state specifically just to make sure that you don't have to do anything now ahead of the game. The other thing to think about is making estimated tax payments. Most small business owners pay taxes on the cash basis, which means you get to take the deduction the year you spend the money. So for 2025, you could wait until you file your 2025 taxes, evaluate whether it's a good plan or not, and then next year when you file in April 2026, say, hey, I'm going to make this election and I'm going to pay $5,000. That's fantastic. You still get a business write-off. But what it's going to do is it's going to be a 2026 business write-off. So it's not going to save you on 2025 taxes. If you have tax planning meetings with whoever your CPA is in the second half of the year, and you say, hey, this is going to be a good idea, and you, before December 31st, make that estimated payment towards your 2025 state pass-through entity tax, then it will be a write-off that you can take in 2025, and so it'll help you this year. Timing matters. Either way, you get the write-off, but it'll be even more advantageous if you can look ahead, like I mentioned at the very beginning, right? The more you do pre-December 31st, the more you can affect this year.
Louisa, I think probably just what I'm getting from one of the people here is, are there instances where people should not do the PT tax, right? Are there instances where it would not be advantageous?
Yes. if you are not going to get to that $10,000 cap either way, it's kind of a useless enterprise because you'll just get the deduction in a different place. So if you're not going to be impacted by that $10,000 SALT cap, you actually don't want to do it. And the reason is really this qualified business income deduction over on the side. So the qualified business income deduction lets you write off 20% of your business income. And if you make the PTE election, it actually reduces the base for that 20% write-off. As long as you're relatively over that SALT cap, you're still going to see a bigger benefit. But if you're not going to get to that $10,000 cap either way, say, you know, it's $5,000 here and then you've got $3,000 of real estate taxes, you're going to write off $8,000 either way. Just depends where it is. So you'd rather do it as an itemized deduction, assuming you're going to itemize because you have enough other things to get you there, so that you can have your qualified business income be higher. Another reason would be if you have losses in other areas. Maybe your business is profitable, but you've got some capital losses you've harvested, or your spouse has a business that is losing money, and so you end up paying less overall state tax by not making the pass-through entity election and letting your personal losses offset some of that business income. So it is absolutely a case-by-case basis. There are some times that it's really obvious, and there are sometimes it's kind of, you know, there's not a big impact, or there would actually flip you the other direction. We use a tax planning software personally at Club Capital where we forecast that in. And there are certainly times that when I'm doing those tax planning calls in the fall and in the winter, that I say, hey, pass-through entity is actually not going to help you this year. I projected it out. Let's pass for this year. So certainly there are areas and times where it's either kind of a wash, so it's not worth the extra effort, or it's actually less beneficial. Generally speaking, higher income levels, more likely to be beneficial.
Awesome. I think we answered the questions there.
All right. I'm going to switch gears now a little bit. I am not getting political here. I am stating facts. However, it is impacted by politics. So one of the things I wanted to focus on this year that's very different than other years is that we have a lot of potential changes coming up for 2026. I'm calling 2025 the maybe last year of status quo. And that's because that Cuts and Jobs Act, the 2018 tax reform that I have referred to quite a few times. If you've been keeping a tally, don't tell me how many times I said it. Much of what was in that 2018 tax reform is set to expire at the end of 2025. Largely because when they were trying to get it passed, they were looking at deficits, balancing the budget, things like that. And in order to get things passed, they had to make a compromise of, hey, we're going to put these in, but they're going to expire in a few years. So quite a few things for 2025, just like you're used to, but for 2026, as it stands right now, are set to go away. There are a couple big ones. There are a lot of other ones. I won't hit in detail on all of them. I'm trying to track time here as I go. One of the big pieces is the bonus depreciation phase out. Bonus depreciation in my career in the last decade and a few plus has never not been a hot topic. When I started my career, it was 50% bonus depreciation. It jumped up to 100%. There were years that they said it was going away, that they extended it in February. It's just always a big conversation. Bonus depreciation says that when you buy a fixed asset, a bigger asset, that you're not going to see all of the value of in a current year, you can write off more of it. Baseline for depreciation for fixed assets, the IRS says, hey, you're going to benefit from this asset you bought for a specific amount of time, so you have to write it off over that specific amount of time. Vehicles are the biggest example I see when it comes to agents, but also things like leasehold improvements if you're putting in improvements for your agency, for your office building, computers, things like that. All of those are considered assets that spread out over more than 1 year. And so a bonus depreciation says is, that's great. You're buying assets. They're going to benefit you for an X number of years. The IRS has it laid out. Vehicles are 5. But we'll let you really like front load that. So if it's 100% bonus depreciation, even though technically you have to depreciate it, you're allowed to write it all off in the year you buy it. And so that's been phasing out since 2018. For 2024, it was 60%. So if you buy an asset for $10,000, you could write off $6,000 of it this year, and then the $4,000 remaining over the next 4 years or the life of the asset. It's going down to 40% this year for 25, 20% in 26, and supposedly going to be gone in 27. Like I said, they've been talking about getting rid of this literally since I started doing this. We'll see what happens, but that is currently how it stands right now. There are a couple big tax planning strategies that this really affects. The first one is the Section 179, generally with vehicles, but with anything. Section 179 allows you to write off a specific chunk depending on the asset you buy. For vehicles, I believe last year it was $33,000 you could write up in the first year, and then the rest of it you'd write off over that 5 years. When there was 100% bonus depreciation, though, you could take the Section 179 expense, and then whatever was left, you could take bonus depreciation and write off essentially the entire value of your vehicle you bought in the first year. As it stands for 2014, if you bought a vehicle in 2014, you do the max Section 179 write-off, and then you take 60% of the rest and write that portion off too, subject to business use. I always have to throw that in there. So as the bonus depreciation phases out, you're seeing less of that immediate first year hit of a tax benefit. You still get to deduct it all over time, but you get to front load less of it. The same thing for cost segregation studies. This comes in if you buy your office building, things like that. Cost segregation studies essentially go in and they say, if you buy a house, depending on the type of house it is, the useful life that the IRS says for a non-residential property is 39 years. So you get, if you buy something, buy a office building, anything like that, they say, okay, you can divide that by 39 and write it off. Obviously that's nice, but the time value of money is a thing, and we would much rather write off more of it this year than in year 39. We want as much in year 1 or sooner than in year 38 and 39. So what cost segregation studies do is they actually go into, they're not cheap, but they actually go into the property you buy and they say, yes, okay, this is a 39-year building, but this building that you bought also has an HVAC system that the IRS says is 15 years. It also has furniture that the IRS says is 7 years. And so instead of saying, hey, you have one asset that you bought for, let's say, $1 million, instead you have 25 assets and 250,000 of that is 7-year property. Another 50,000 is 15-year property, and then the rest is the 39. So it lets you pull ahead when you're going to take the expense. When it comes to bonus depreciation, kind of similar to the Section 179, the types of assets that qualify for bonus depreciation are those 7-year assets, those 5-year assets, kind of those sooner ones. So instead, even of saying, hey, I've got $250,000 I can write off over, let's say, 7 years. If it's 60% bonus depreciation, okay, I can actually write off 60% of that this year, see the related tax savings. And so it's a great 1 to 2 year or, few year tax savings. Now that the bonus is phasing out, cost segregation studies still going to be useful, but you're going to see less of that first year, like, hey, I bought a building and I just wrote off $100,000 of depreciation this year. Like, that's going to slow down because of the cost segregation, because of the drop in the bonus depreciation.
Just on cost segregation studies too, I think for those listening here, I think still if you do a lot in real estate, right? I mean, this doesn't have to be like you're someone that does 7 properties a year type of thing, but the cost segregation is really around real estate, and you should definitely pay more attention to this if you have not already, and look into this. A lot of people own their buildings. It could be very applicable there. There's generally a certain threshold where it makes a lot of sense to do this. Cost segregation studies can cost a good amount. I mean, it's not like we do this. There are firms out there that do this type of thing. They can cost $10,000, $15,000, $20,000, right? So it's got to be worth the ability to go spend that type of money, right? So there's like generally a value of property that makes sense. And they can help with this. And we have some recommendations of like, vendors to use and things like that, but you should definitely look more into it if you haven't done it before. Definitely some of the bonus stuff is phasing out. But even that being said, if you can take an entire asset, that, you can say $1 million asset that you are going to depreciate over 39 years, and you have the ability to depreciate, portions of that over 5, 7, or 15 years. It is a big impact to you, even if that's all you're doing, and you're not getting the bonus depreciation in year one. So, it's definitely worth looking into from a tax perspective, and it's definitely, I would say, one of those more underutilized strategies that we see.
And the other thing to keep in mind is definitely before you shell out that large chunk of money, talk to your CPA. And another thing to project out, because something we see sometimes is people who are not active in rental properties doing a cost seg on a rental property and being really excited for a big year one write-off, but their rental property actually only qualifies as passive income because they don't meet the requirements to be active in that rental business. And what that means is, depending on your income level, if you have passive income, you are allowed to take expenses to either get you to zero, or to go, if you're lower income, you can take up to $25,000 of losses in a current year. So if you do a cost seg study and you create a giant write-off, that's fantastic. But what's going to happen is it's probably going to get limited in the current year, and then it'll roll forward to future years. Might still be worth it depending on what your rental income you're projecting is. But I have seen that happen before, where somebody's really excited. They went and they bought the rental property, they did the cost seg study, then they came to us and said, wait, why did that only save me $1,000 in taxes this year? And we had to say, hey, it's because you did it on a passive activity, so you're going to get write-offs for future years, but it's not going to be that year one savings you were anticipating. So make sure you meet with your CPA and they can review the activity you're doing it on and make sure from a tax perspective it's worth the bang for your buck. It often is. But we do see sometimes people get really excited because they hear Micah and I talk about these big numbers, and then they don't sit down, and make sure it makes sense for their specific situation before they do that.
Let's maybe, I think, jump here, but one question was, do we expect Trump to reestablish some of these preferred bonus treatments?
Yeah, so I'll hit on that on the end. I predict nothing. I've learned I predict nothing, but I will hit on that a little bit at the end.
That's generally what I would say as well. I'd say I'd surprised if there were not some good tax benefits that his administration wants to push out. But it's very hard to say as soon as when those would actually happen too. So from my understanding, there's not a lot that's out there right now of specific legislation that is trying to come through. So I definitely wouldn't plan or strategize around the speculation right now. And it might take a little bit for that to be the case anyway, and it might not be this year. It could be next year, right? So we're not sure.
Yeah, exactly. And that is really where this next one comes in, this qualified business income deduction. My personal opinion, that doesn't mean I'm right, but my personal opinion is this is going to be the most impactful change for our agents and for small businesses across the country if this does actually phase out and drop at the end of 2025 like it's currently on the list. The qualified business income deduction came about at the same time that they cut the corporate C corporation tax rate down to 21%, also in that 2018 tax reform. And they were like, okay, how can we help the little guys? We just made a big cut for the big guys. How can we make a cut for the little guys? They threw around a lot of different options. And essentially what they came to is, we're just going to create this additional deduction, additional write-off on your personal tax return that says you can write off 20% of all of the qualified business income you have. S corporations, LLCs, sole props. There are some nuances to it, which I won't go into here, but essentially it says, all right, you can have a 20% write-off. And what that equates to is, since 2018, you as a small business owner have only been paying taxes on 80% of your business's profit. That is set to go away at the end of 2025 based on the current tax law. Interestingly, the corporate tax rate is not going back up. That was a permanent change. This had to be made a temporary change. So that, I think, is going to be a very big adjustment and shock to people who essentially are now going to pay taxes on 20% more. So as we're thinking about tax planning considerations going into 2025, especially the second half of the year, the first thing I'm going to say is, don't do anything rash right now. Don't make any specific plans, because to Micah's point, we do expect something to come. We don't know what it's going to be. We do expect something to come. So keep an eye on upcoming legislation. Keep an eye on whatever CPA blogs you're subscribed to, whether it's ours or anybody else's. Look what people are saying. And then if we get towards the end of the year and it looks like truly it's going to expire, think about paying more tax this year. I know that sounds crazy. It is not what I normally say. But this year you get to write off 20% of your profit. So consider pushing spending into 2026, leaving your 2025 profit higher so your 20% is higher. Try to maximize that 20%, even though that means, hey, I'm going to pay a little bit more in taxes in 2025. And then where normally, and I had this conversation with tons of agents last year, we talked about, hey, anything that you can pull ahead that you're going to spend in January 2025, pull it and spend it in December 2024. This year, if QBI is really expiring, I'm going to give the opposite advice. I'm going to say anything that you can say, hey, normally I pay you, December 28th. Can I pay you January 1st? Push whatever you can into 2026 so that you can kind of spread out the hit. Maximize that 20% write-off this year in 2025 and give yourself a few extra write-offs next year in 2026 when you're going to lose the 20% write-off. It's going to be impactful if it truly does go away at the end of this year. And the interesting thing I find when I'm talking to small business owners is many of them don't realize they were getting it to begin with. And now I'm telling them something really good for you is going to go away. So this is something to keep an eye on there. I'm going to skip ahead a little, wrap this up, and then I'll speak to that final point. There are a number of other ones expiring. This is not a full list. This is just some of the higher topic ones. The increased child tax credit used to be $1,000. It's currently $2,000. It is set to go back to $1,000 per child next year. This is probably the one with the most bipartisan support to extend. Everybody agrees raising children is incredibly expensive, and that $2,000 doesn't even come close to cutting it. So that one does have very good bipartisan support to move through, but obviously it'll depend on what else comes through. That state and local tax cap is also set to expire. This one's interesting because it was a part of the original tax reform, and it's got to be the least popular thing that there was. So I wouldn't be surprised to see this actually expire, even if they do pass some extensions of other ones. That will affect the things like that past serenity tax I was talking about before will become applicable in less situations. There will still be a place for it, but fewer people will benefit from it if this truly does go away. They cap the individual tax rates with the tax reform. Those are set to go back to pre-reform rates, so up a little bit higher. The essentially doubled standard deduction is set to go back down, so more people will itemize than are currently itemizing. And then the last one is they paused alternative minimum tax, and that is set to come back. So not an exhaustive list, but a few things that impact a lot of people that are set to expire at the end of this year. To Micah's point earlier, to the question earlier, I said I was going to talk about it at the end. I don't know what's going to happen in the next 11 months. If anybody says they do, I want to know who they're talking to, or I don't, question them a little bit. What I do know is that Trump has indicated that this is a priority for him to pass something. It is likely to involve a lot of the same things that are expiring. This is his legacy from his first term. So he has indicated that he's committed to continuing that legacy. That being said, it's not a one-man show. It is not, and there are a lot of other pieces that go into it. That a lot of the reason all of these are expiring is because they were a lot of, not all of them, in many ways, tax cuts. If you cut taxes in a bill, you have to show where you're going to get the money from in other ways. The way they got around that in the first tax reform was by making these temporary and making these expire. That's really the reason they are expiring right now. It was basically the compromise to pass the 2018 tax reform. So as they go in to build a new bill and say, hey, we want to keep the reduced individual rates, we want to keep the increased child tax credit, the question, the back and forth is going to be, okay, well, where's the money going to come from? Obviously, that's way above my level, but just to illustrate, it's not as cut and dry as people really liked this, so we should do it again. There's going to be more complexity to that. And so there's a lot of things that are going to be moving, things that in common circles seem to have a lot of support. Is the qualified business income deduction, is the increased child tax credit. Like I mentioned, the one I think most likely to go away is the SALT cap to let expire, because that honestly overall had a horrendous response to it. And with the passing of these PTE taxes, it kind of, people found the loopholes, right? And so that one I wouldn't be surprised if they did let expire. This is all me just based on my reading. It's not just me, right? But these are all opinions. So the biggest thing that I can say when it comes to this year is keep your head down, kind of keep, looking at it. There are basic tax strategies that are always going to apply. Spending responsibly, spending where it makes sense, looking at, Mike is going to laugh. My favorite example that I gave a lot of people this year is please don't go buy $5,000 of printer paper on December 31st. Yes, you saved about 10% in taxes, but you also had printer paper until, the apocalypse. You could have used that, paid the taxes on that $5,000 and used that money for better things. So spend reasonably, spend responsibly, keep your eye on what's going on. Don't make any rash decisions right now. Don't freak out because of what might be coming in 26, but also don't make plans that assume 2026 will be the same, because I think there will be changes. We just don't know what they're going to be yet. The second piece of that is talk to your CPA, whoever it is. Taxes are not a once-a-year relationship, especially this year. Have tax planning meetings in the summer and in the fall and in December, whatever it is. Have those kind of open conversations. So as things are moving, trust me, I'm reading a lot. I have 4 different roundups coming in my emails every morning, and I'm reading all of them. As I was prepping for this specific presentation, I asked ChatGPT to give me like 10 different articles of other people and their opinions of what's coming so that I could come prepared to this. It's job security, we'll call it that. But like, we are paying attention. Your CPAs are watching. We're trying to stay ahead of this. Things are going to change. So stay connected into them. This is our job. It's not yours. But it's your money and it's your business. So definitely make it a two-way street so that you feel like you know what's going on, and keep tracking.
Yeah, just some final comments, probably hand it back over to Gina and Kelsey. But this is not the last webinar we'll be doing on this, right? So we stay our team stays up to date on everything on the policy side as much as possible, right? Very much encourage you to be doing the same, right? A lot of this stuff hits headlines, not all of it though, right? Not all of it hits the headlines. A lot of this stuff can be buried, and we try and kind of fish through everything and put our take to it, train our team on it, etc. So please make sure you kind of continue to follow us, whether that's on social media, blogs. Obviously, a lot of our clients will already be getting notifications of additional webinars and topics and things you need to know. But if you're not a client, follow us on social media and follow our blog, because we'll be putting out content if there's things that are changing, and things that agents need to know.
And I would add to that, go past the headlines, because I see a lot of headlines pop up that are not anything like the headline actually says. Very, sometimes alarmist, or hey, you're missing this deduction, or you're missing this. So just because you see a headline, read the article, ask somebody, ask the CPA if you see it, but don't see a headline and take it for fact. I think we all know that, but just to emphasize, the headlines don't always tell the story. They just want you to click on it.
Thank you so much, Louisa. Thank you so much, Micah. Thank you everyone for coming. Like we said, we will send out this recording and we will follow up with, of course, all of Club Capital's information as well. Hope everyone has a great day.
Thank you guys so much.
Thank you.
Thanks.